than 4% each year.
Yeah, I mean, I think it's a theme this week about looking at the themes that through ESG and SRI investing about what the correlation is with Sharia. It's just sort of marrying that two together. So I feel it's a sort of work in progress at the moment. But yeah.
Thank you for the excellent presentations. The thing that I wanted to raise is in relation to throwaway plastic products, which clearly is an issue which has been raised in various ways by David Attenborough, Planet, etc. To what extent is it there are different ways of dealing with it? That is at the stage of people who are using, reduction of use, recycling, waste management. But I'm wondering whether at the corporate end, where you're targeting your ethical investments, and non-ethical investments, etc., in deciding, are you able to see ways and means of being able to use that particular tool to actually get at the production end of plastic or throwaway plastic products? Because if you could control at the production end throwaway plastic products, then it'll be a certain help to reduction of plastic generally.
Absolutely. I think one of the keys is recycling. I think if you look globally, recycling rates vary between countries. In the US, it's relatively low. In the UK, it's relatively high. We engage with all of our companies that we invest in. Most of them have sustainability documents. Most companies are aiming to reduce plastic. It's one of their KPIs. We would like them to go further and move it from their sustainability report, which, if you're cynical, is a marketing document, and move it into their annual report. Once it goes into there, it's more of a sort of a legal document. But regulation is probably the easiest way to drive consumer change, because we can tackle company by company as we go along, and it's quite an arduous process. If you can get regulation to change, companies will stick to that regulation. So I think the key is trying to force regulation change.
Okay, gentlemen.
I was just going to add. I think, for example, landfill the gate prices need to come up a lot, and they'll change a lot of behaviours. You see that, particularly in the likes of Australia, where you're seeing Queensland just brought in a new levy. Waste was being transported out of New South Wales into Queensland because there was not a levy on landfill in Queensland, because Queensland has a lot of holes in the ground from mining. So, but they brought that in. So I think it's a behavioural change led again by policy and regulation. So, but I think going forward we'll see waste as a valuable commodity. I think there'll be a price on waste. And if you look at what I said about Mohawk and the fact that it's an input cost, and you're starting to take what is effectively someone's garbage and using that as an input, so you don't have to spend money on expensive resins or expensive hydrocarbons to make your product, then that's worth a lot of money. So there's companies in Australia, for example, like Bingo, who do the same thing for commercial and demolition waste, and they sell the aggregates back to the brick makers or the timber back to the timber merchants, and they make more money from post-collection than they do collection. I see that model replicated across a number of different waste streams.
If I could just pass a small note on that, is that plastics is the way things are made, but most of the biodegradable alternatives of plastics are paper and pulp. So fundamentally, on some level, we see this as can you service the demand in ways that are economically viable? And that has to do with the cost of paper and pulp.
Okay.
Hi there. Just a question for Ian, and then one for David and Alex. We've already kind of touched on it, so I was going to talk about the genetic diversity and everything. But with regards to moving into countries like Africa, the problems we had from palm oil with regards to destruction of ecosystems because there was an opportunity to make money, and so-called wasteland, which had biodiversity, I think it was a 90% reduction, and the infrastructure where the carbon saving was offset by the actual transport of the goods. Is this something that you look into when you go into these places? Do you make sure that farmland or land isn't being destroyed and then presented to you as derelict land? or does it end with you that you don't look at the supply chain further?
If I hear you correctly, yours is a question of what we call life cycle analysis. Is that correct?
Yeah.
And if I can lean on a little bit of what I know about FSC certification, is that the bar on life cycle analysis is quite high.
Yeah.
Because for you to become FSC certified, they don't only ask the question of how you run your plantation, of what you plant on it. They ask you, how did you come into possession of it? And where is it going afterwards? And if I can say that the bar is actually, it has its problems. But the bar is pretty high because if you have a holding company that has 7 subsidiaries in different places, and if you have one transgression within affiliate companies, the whole group loses its FSC certification.
Yeah, no, I only ask because it's not your responsibility, but do you go and look for that and make sure? And for David and Alex, I was just going to ask with just differences with in-house RI. I can see that you hold Facebook, and Eden True, we don't hold Facebook. Do you think that your personal in-house RI and SRI views and ESG views should be more prevalent and with the way that the industry presents funds, ethical and responsible funds, instead of just saying ESG and RI? Do you think it should be a more personal in-house view on things, and you should be more actively engaging investors with regard to that? Because if it's an in-house view, then technically I could have an in-house view that I like oil and say it's ESG.
Sure. I think Facebook we rate stocks internally, and ESG, the Facebook rating isn't high enough for the funds that I manage. But there are people who like the theme of digitalization and social networks and things like that. So, for me to say that it's okay and not okay, it's just a view, and everyone has different views. I'm sure you can find any company in my portfolio and someone can have a negative view on it. So we're not trying to preach. What we're saying is we have a bar, and we think that certain companies don't make that bar, and if they don't make the bar, then we don't invest in them. That's the essence of what we're trying to do. But again, we are active owners. If we can help, or if we think we can help improve the governance or the social impact or of any of the companies in which we invest, we will do so, and we will have open and honest dialogue with the board, with the senior independent directors. Yeah.
I think that's a very, very solid response. I think there's no perfect company in the world. They don't exist, and the same as a perfect investment doesn't exist. There's shades of grey or shades of green, you might want to say, but I think the standardization around negative screening is very much there, but when you're looking at kind of in the sustainability sphere, then it's a lot more open to interpretation to how much that company really impacts in terms of solution perspective, and that's really why we're trying to build as companies report better and get a feeling for what they're actually achieving with their operations, just how they're impacting the world and how much they're going to create that sort of solution. I think we're in definite need of a digital kind of ethical code for the likes of the FANGs and Facebook. I think we've seen the impact that had on Brexit with Cambridge Analytica, et cetera, et cetera. We struggle to invest in most of the FANGs bar Google for what it does in terms of Waymo and things like that. It's a very positive side of things, but there are various shortfalls for some of those companies. I think that's very, very company specific. So it's company by company, but you're only as good. It comes back to what I said. You're only as good as your lowest quality holding, and then you just keep looking at those holdings and see if they measure up, and if they don't, then you have a very clear view on a shortfall.
Okay. Thanks, Lucian.
Thank you very much for your presentations. I didn't hear about how you ensure that people working in countries in Africa where you invest, whether they are compensated fairly and looked after. Also, you mentioned that you're not Sharia compliant, although I think Alex mentioned that you don't deal with gambling and others. Do you have Muslims from Muslim countries or in Europe investing in your company, and if they do, what sort of percentage is there, and how do you sort of market in those countries? And I think last question is to do with do you invest in your own companies? And would that create trust in your clients that if you do show that you are willing to put your money where your mouth is?
Okay, if I can remember the first question. In terms of Africa, we don't have any direct African investments. I think the closest investments we would have would be some certain retailers who have supply chains within African countries. We certainly hold those companies to a high bar, and we will assess their assessment of their own supply chain. I think if you look at, AB Foods isn't a perfect example because of fast fashion and recycling, but they are ranked very, very highly in a report called Know Your Supply Chain. So they go out and they do lots of visits to the factories that are making all of their clothes, and they go in there to make sure that the workers are, and the welfare of those workers is well looked after. The next question, I think we have many retail investors who I would never know personally because they will invest through platforms. So I can't really give you an accurate answer on Muslim investors into the fund. Will, who is sitting next to you, may have a better idea as he works in sales. In terms of investing in the fund, most of us as fund managers have our deferred bonuses are invested in the funds that we manage, so we do have skin in the game. I think that's probably the same for most fund managers in the city. It is an FCA requirement to have bonuses deferred and invested in the funds that you manage.
Hold on, I'm just going to add something there as well. It's not Africa, but what happened with the Rana Plaza in Asia, there was Eden Tree, where you were involved, weren't you, significantly in actually trying to improve conditions. Maybe it was a little bit too late, obviously, for what had happened. But I think post that supply chain, and actually, again, it's a little bit about shareholder action to go in and actually improve conditions. It hasn't gone far enough, but I think that it's a work in progress, if that's been fair, David, isn't it?
Absolutely fair, and I think it's really important to have that supply chain transparency. To ensure that workers have the rights, that we see a degree of unionization in areas where there could be potential for abuse. We're signatories of Modern Slavery Act. We're heavily supporting the Worker Disclosure Initiative, which is effectively a social and kind of worker equivalent of the CDP. We're seeing more and more people signing up to support that and really give workers a right, particularly in emerging markets and in Asia and in Africa, where they could be far more subject to abuse. So,
okay, now David, I know you've got to. Do you want? So, panel are going to be here till past, so we can still take further questions. But I know David's got a train to catch, so could we maybe give David a round of applause before he goes? Here.
Thank you for the presentations. I just wondered whether the one thing that you haven't touched on, I'm pleased really kind of to see that you divested from Shell, even though part of the compensation of the CEO of Shell is kind of going to be driven by some targets, achieving some targets on the environment. So I just want to get the views of the panel regarding the delisting of companies that do not meet a certain level of environmental protection. So this is kind of the idea really of the McDonald, the shadow treasurer from the Labour government, saying that all companies that do not meet certain level of the environmental protection are going to be delisted. Or should we leave it, so that's relating to the regulation, or should we leave it to investors like you, big funds, etc., that are going to divest? And there is an article in the press by Campbell from the Liberals saying that, those companies really, they don't need to worry because, some funds are going to divest, some will succeed even through the targeting of those companies, like for example, what happened with Vedanta that had to delist because of the Norwegian Sovereign Wealth Fund that divested their funds, but many others, they don't succeed because people think probably that it's not the fault of BP or Shell that they are there. It's because of us as consumers. It's because of of many investors. So I just want to get the view of the panel really about this idea that companies, they should be delisted from the stock exchange, in particular the London Stock Exchange, and maybe the other stock exchanges are going to follow if they don't achieve a particular target in their environmental protection.
I think delisting is probably a step too far. It goes back to regulation. I mean, tax, audit, accounting, it's all regulated. Now, companies, like Shell, any FTSE 100, FTSE 250 company will abide by the law. So if you can make regulations tighter, they will typically, I can see you shaking, they will typically abide by those rules. So, it's key as investors to engage and ask for tighter regulation, better governance standards, more accounting information, so we can make informed choices. The Shell example, I mean, our point is that they have increased their capex into fossil fuels, and they're going to spend between $27 and $30 billion of shareholder capital investing in more and more fossil fuel extraction. We don't think that that's a sustainable business model. We've engaged with them, and they're not going to change what they do. So we then took the view that actually we've tried. We don't want to just divest for the sake of divesting. We do want to always challenge businesses and try and get them. It's called nudge theory. I think try and nudge them in the right direction. But ultimately, if we believe shareholder capital is at risk, we will divest.
I think, I'd agree that getting someone delisted is a step too far. I think, in addition to regulation, I think shareholders hold a lot of power, which is evident. People are doing it. We're seeing it here. This is the example. And I think ESG and people looking at the sustainability of people's business models and the companies they invest in is becoming more prevalent. Perhaps an example would be how we would have bought chocolates, bananas, and tea and coffee prior to fair trade. I think you'd struggle to find a non-fair trade banana in a supermarket, or tea, coffee, and so on. And that's taken a number of decades to come through, but it is now a standard. And I think from an investment point of view, we joined a number of years ago the Social Stock Exchange with a view of trying to, it hasn't necessarily lived up to and done what it needs to, but to create a badge, a fair trade of investment, so that it can be easier for consumers or investors to identify companies that meet and match their view on what they want to try and do from an environmental, social impact point of view. So I think the market will come to it, and if anything, it's accelerating now. I think we're hitting that critical mass, and more investors are contacting yourself. We're more engaged in it. If you'd had this conversation 5 years ago, it would have been crazy. Why is that important? Now it's actually really important, and mandates are driven, and ESG is really important. So I think the market will come to it. And those companies who don't pursue positive ESG outcomes will be left behind. Over time, they'll disappear. They will change their behavior. That's what I believe.
I'd like to add a matter of fact. 2 to 3 days ago, I think you can verify this really quickly on Google, that the French oil giant Total, whether you see it as a sign of enlightenment or you see it as a sign of remorse, has set up a dedicated business unit to invest in forests. So I think this is clearly a sign of the times that you're talking about.
Any more questions? I'll get to
Thank you. I have 3 questions. One for Ian first. And I understand that you have now located to Luxembourg. Now, how can I invest in your fund as a retail investor? So that's one, yeah? The second one to Joe. Joe, do I see that you are also interested in investing in old age care? As that becomes, and how would that work out, because we have projects which we want to look at doing some old age care provision, as obviously state provision is becoming very, very problematic. The third one is to all of you. We talk about investing in companies. But as me and Professor Mezian have been discussing all over, private equity is taking over many of these companies. And those are not accountable. Those are difficult to police. So if the amount of shares or publicly traded shares is going to come down, how will you have a handle on private equity providers?
Well, thank you for the question, Iqbal. I'll be quite direct about this. We have just acquired our first asset out in Estonia, and we will be opening for basically our proof of concept sometime after summer. This proof of concept, we're speaking very actively with regulators, and I think we're going to conclude that we need to run a small proof of concept for retail investors to what we call battle test our technology. So this is coming extremely soon. However, what's coming is that we're currently in discussions with the Luxembourg government, particularly the International Climate Finance Accelerator, who's really seeing this as an opportunity to shape a frontier market impact fund that is open-ended and can be appropriate for a vast array of different portfolios, including retail. Whether we can come out of the gate as a retail-ready fund is something we aspire to, but this is really a question that we're dealing with the Luxembourg regulators at this point in time.
Extra care is a market space that we're very interested in investing. People may not know, extra care is housing with support for people aged 55 plus. And it sits in the space, and it's a really important space before people go into more domiciliary care, a care home setting. Care home settings are quite expensive, and it's that bit in the middle of what happens when you want to live independently and you want to adjust the amount of support that you need. So it is actually a model that is growing throughout the country. There are different parts. We've dealt with a number of commissioners who, especially following the last census, are looking at this as investing heavily in the space. So no, it's something that we're very keen on, and we have a number of partners who will be operating the schemes, and they tend to be relatively large, usually around 50 apartments, more weighted on the kind of one-bedroom apartments. They provide independent living, and we're also looking at other models which we would, I guess, loosely call care villages, which involve extra care, but also working through to providing support and care for people that may end up with dementia. So what's happening is you're not having to leave your environment, you're actually staying there and getting that high-level care. And what's unique about the care village model is one of the biggest costs for local authorities is actually providing the care, not the property. And if you can keep that central, then what you're not having, especially when people have less need, is a situation where carers are travelling and spending 10 minutes with lots of different people. So there are actually really innovative solutions coming, driven by property, which will have a positive impact on the actual social outcomes and the outcomes for people who use the service, but also save money and therefore create value as well. So no, it's definitely a market space that we're interested in.
From a private equity perspective, well, firstly, for the fund and performance, if any private equity house wants to come and purchase some of our holdings, it will certainly be beneficial. But you're right, companies going into private equity hands, you will not have the disclosure. It becomes a private company. They will no longer disclose any material information to the public that they don't need to do it. So if you're an investor who, wants exposure to active management with a strong ESG and stewardship overlay, private equity is probably not the right investment vehicle for you. A company, you can see the holdings, you can see every company that we have investments in, you can hold us to account, and you can judge whether or not we are doing what we say we do. Most private equity vehicles are very closed. They don't publish any data. You will not get that level of disclosure.
Iqbal, I know that you just make the age criteria for Joe's investment, but I hope that's not you looking for property for yourself.
Scott, if I could add on this private equity question. Private equity and nature has rarely been seen kind of close together. I just wanted to throw out as well that we see a distinct opportunity for arbitrage in private equity, particularly in forestry and natural assets. The reason is that this is an asset class that requires a lot of structuring and pre-structuring. And a lot of these assets being uninnovated at this point in time they're very inefficiently priced. So what we foresee is coming is that through Sukuk innovations or through technology, that a liquid market is coming. But we have a very small window that we believe that people, enlightened private capital and private equity, have a distinct advantage of even getting double-digit returns just on acquiring these undervalued assets, structuring or restructuring them before they get listed as Sukuks.
Right, two more questions then, and then we'll call it. Okay.
Thank you very much. Sorry to get the question so late before everyone wants to go for lunch. Ian talked about, acquisition of wealth, whether it's been acquired responsibly. So that raises an interesting question in itself. If wealth has been acquired irresponsibly and we invested into, it's a question to all the panel, and I'm Mr. Zardari and Mr. Nawaz Sharif of Pakistan. I come here with £100 million, which has been acquired very irresponsibly in peculiar manner, and I come to the fund manager saying that here's £100 million, would you take it? Will you take it?
I think we have challenges with accepting money. That it's an interesting dichotomy. And I don't know necessarily I'll be able to solve it in the next 30 seconds. Yeah, I think I'll leave it there.
I just echo those words. We have AML and all of this, going on. I don't think we have a distribution branch in that area, so it's unlikely that we would get the invitation.
Well, if I have to comment on this, well, I gave the Total example. Depends on what you mean by irresponsible. You have a hydrocarbon company that, whether you're cynical or you're optimistic, is actually saying that they want to reinvest in natural capital, and personally, I don't see a problem with it.
Any more?
Thank you very much. Thank you very much. I'm sorry, the mic's not working. I guess my question is around technology and how technology is valued in terms of your ESG model. So is technology always a good thing, and how do you weigh in the kind of human cost of it?
I think a good example of technology and weighing up against the human impact would be somewhere like Amazon. You look at the number of high street retail in the US, the number of people who have lost their jobs in retail as a direct consequence of Amazon. If you go back to 1950, there were 400,000 elevator operators in New York. Okay, technology changes, it will continue to change, and I think it will continue to have an impact on jobs. But if you look at the unemployment rate and the number and the participation rate and the number of people employed, naturally these people go to other places. So, there are more delivery, Uber and all of this gig economy, none of this would have existed 15, 20 years ago. That is an industry that has grown exponentially from technology. So there are always puts and takes, I think, with technology. I think you're right, not all technology is good. But currently we do see a lot of benefits of technology.
There is a little bit of an arcane discussion about technology, particularly I think by the father of the term disruption, about whether a particular technology is a market-creating innovation or it's an efficiency innovation. There's a third category they call sustaining innovations. And the idea being that if it's an efficiency innovation, it tends to free up capital, but it tends to eat jobs. There's another bit of it, which is a market-creating innovation is taking something that is big and expensive and turning it to something accessible and open to a larger group of people and thus improving their lives. Just the same way that you had the mainframe computer going to the personal computer, going to the laptop, and now going to the smartphone. I'm probably by nature a little bit more optimistic about the role of technology because I see all these market-creating innovations.
I think specifically with the market that we address, we're very positive on technology because invariably we're seeing the utilization or the use and implementation of technology of helping people, especially in healthcare. So whether that's the introduction of doors that you can control to open and close for yourself, So for us, technology is a great thing in the space, and but again, we're not at the market disruption end of getting rid of lots of jobs. If anything, there aren't enough people in the care sector, so technology is invariably having to become more prevalent to make up for that shortfall.
Okay, can we give the panel a round of applause? I think that was a fascinating discussion.
Thank you very much, everybody. We will now break for lunch and prayers for those who want to pray, and then come back here after lunch to have an interesting session on financial inclusion. So enjoy your lunch and be ready for the next session. Thank you very much.